Welcome back, everyone, to another awesome episode of BIF Bites, first episode of 2020. I'm your host, Jerry, joined as always by my awesome co-hosts. We got Mike Long and Brendan Flaherty in the cast today. How you guys doing?
All right.
Good. Happy New Year, everybody.
Yeah, you too.
Definitely.
Psych.
2019 was a good year. 2020 is looking even better. So we got a fun episode to go over today. You know, some new legislation. Nothing says fun like new acts of Congress, right, guys?
Yeah, I can hardly wait every year end to get the last minute stuff.
Today we're going to be talking about Secure Act, right?
The Secure Act, not just Secure Act.
Oh, sorry, you're right.
Secure Act.
Secure
It is
Act.
the
Gotta
Secure
emphasize it. So this was some regulation that was passed in May of 2019, and it's kind of the talk of the town for the financial industry as far as financial planners wondering how it's going to affect their business and individual clients wondering how it's going to affect their retirement, which is, always kind of a touchy subject with clients.
Yeah, isn't it? And this, like so much legislation, was tacked on to the end of I think it was 1,700 page, or maybe the act was 1,700 pages, but it was tacked on to the end of appropriations bill to keep the government running, I think, for like 90 more days. And
just signed into law like on the 30th,
yeah.
I think, December 30th. So despite being passed.
Yeah, and there wasn't a whole lot of talk about it prior to that, it seemed.
Right. It just kind of came out of nowhere. I mean, it wasn't really even much of an acknowledgement that it was happening in May. It just was, hey, this is going to be signed into law, and here's all the things that it affects.
Yeah, I know I didn't hear about it in May. I probably heard about it for the first time in early December, right when it was getting, officially signed into law. It really flew under the radar.
It really did. And the more you flip through it, it's like, wow, that impacts individual financial planning. That impacts financial planning. That impacts the employer sponsor of retirement plans. It's like, it's a lot of stuff in there.
Yeah, there are some huge changes.
And it's actually a good point to bring up that, people who are in the program currently or in any program currently who are going through their course of study, things will change as you're going through the study, so it's important to understand when these changes will be implemented into the exam cycle by the CFP board, which I would hope we'd have some clarity on.
Yeah, I'm wondering if it's going to go into effect for the July exam. But I wouldn't be
have
surprised.
heard it is.
Yeah,
I would imagine it would.
I think so. I just, when it comes to the CFP board, you never know. I wouldn't also be surprised if they decided to postpone it to November, but
which they typically like to do
right.
with their big changes in November. But for something like this, wouldn't be shocked to see it in July.
Yeah, so no word yet from the CFP board, at least at the time that we're recording this, but I'm sure they'll probably get that information out to us definitely before the July exam.
Yes.
Let's kind of get warmed up. Mike, you had a great little practice question here that goes over the Secure Act, and this might be a bit unfair for our listeners who this is their first time hearing about the Secure Act. You're probably not going to get this right, but for those of our listeners who are a bit more in the know and have already kind of looked over the act, this kind of practice question will represent one of the bigger changes the Secure Act has gone through.
Yeah, if nothing else, it hammers home that we need to go read this because even some things we are very simple, boom, that has changed now. So
let's dive into it. I'm going to throw this one out to you guys and see how you take it. So Harry and Emma, both age 71, file taxes as married filing jointly. Emma retired last year, and Harry continues to work full-time simply because he loves his job. Harry earns $75,000 annually and continues to contribute to his employer's Section 401k plan. Their MAGI is $85,000. Harry has asked how much they can contribute and deduct to a traditional IRA for 2020. Is it A, contribute 0, deduct 0? B, contribute $6,000, deduct 0. C, contribute $14,000, deduct $7,000. Or D, contribute $14,000 and deduct $14,000. So first, what would be the answer under the old rules?
0.
Right. And how come?
Well, the old law had a maximum contribution age of 70 and a half.
Right. Once you hit RMD age, you were not allowed to contribute to traditional IRAs anymore. You could do 401ks if you were still working there, and you could do Roths because Roths don't have the RMD. But once you hit RMD age for traditionals, you were locked out. So what is it under the new Secure Act guidelines?
What do you think, Brendan?
Well, so from my perspective, it looks like that answer D would be correct.
So going from the zero contribution, zero deduction, all the way up to being able to contribute $14,000 and, most importantly, deduct that $14,000 as well.
Yeah, there's a few things in play here. We've got an active participant, right? Because he's in the 401k plan at work, yep. And a spouse that is not working outside the home. So we had to consider all of that, and at the end of this, there's a new $14,000 deduction, which, when I wrote this, I was thinking about like a small business owner where, they often work till 80, 85 and continue to have taxable income.
Yeah, I think this change is huge for, late in life financial planning. Just having the ability to make these IRA contributions and take the tax deduction on it is going to be huge for exactly what you said, Mike. Those people who are, running the small family business, maybe they have like a family convenience store or like a father-son business, any of these like, small town mom and pop shops. This is a pretty big change for them.
No, and the other thing I was thinking is, the rule where if you continue to work, used to be 70 and a half, and you're at an employer-sponsored plan, you could, continue to do that, and that would not be taxable income currently. Unless you were a greater than 5% owner, then you couldn't do that. So this gives that mom and pa a way to have deductible retirement plan contributions.
And certainly addresses a need. One of the issues that I think that we are all going to start seeing is the lack of saving for retirement. So this gives people an additional 2 years, because we are certainly seeing people working longer in life or later in life. And so the ability to continue to kind of feather that nest for retirement whenever retirement may be.
No doubt.
Yeah, 80 is like the new 60 of the 1950s.
Yeah, it goes around.
Hopefully 60 is the new 60 by the time I get there.
So, that's a good warm-up question. Let's dive in to, the real meat of the Secure Act, because it's a lengthy bill. There were a ton of little things that were introduced in this bill. I just kind of want to go over it. Really, when I was looking through it and reading through all the changes, I felt there were kind of two main, topics that the changes fell into, and it was either quality of life changes that just make these types of accounts and investment vehicles easier for the average person to understand and handle. And then the other category is some pretty significant, regulation changes. So first, let's kind of go over the quality of life changes, because I think there's a lot in here that just makes things a lot easier for people. So I would say probably first off, we touched on it a bit with the question, but eliminates the age limit for traditional IRA contributions. I think that is a big quality of life change for a lot of people, because a lot of clients who are kind of managing their own IRAs, maybe they have a Fidelity or Vanguard IRA. They don't really have a financial advisor. They didn't know about these limits, and they would make the contribution, and then they would go see their tax advisor, and their tax advisor would say, hey, you're getting slapped with, a fee because you over-contributed to your IRA. You weren't supposed to make a contribution this year because you hit the age limit.
Yeah, I think it was a 6% penalty for contribution.
Right. And also, one of those areas where once they start looking, you never know where they're going to stop looking, right?
Oh, yeah.
So it could be a potential audit flag.
Oh, yeah, that's a good call, too. If you do that, all of a sudden you're on a list to get audited, and it's an even bigger headache. My biggest problem with those things also is that it felt like a tax on the people who are least likely to be able to afford the tax, because the clients who have the financial advisor who's good and is on top of their game and catches these things for the clients, they're the ones who aren't going to be facing that penalty, whereas they're more than likely the ones who could probably afford that penalty. Whereas, someone who's later in life maybe only has $10,000 in an IRA because they started it a couple of years ago, That 6% penalty would definitely, ding them harder than someone who's, been having an IRA for years and years and years. So we kind of touched on that. That's definitely a big change, eliminating that age limit. But also, I think one of the biggest quality of life changes, at least from my perspective, because this used to give me nightmares. I used to have to deal with this all the time explaining it to clients, is they increased the RMD age by 18 months. It's no longer 70 and a half. It's now 72.
And again, also an advantage for most people, where if you're, it allows you to make the initial distribution a year and a half technically later than you have to right now. Again, we're saying that people are working a little later in life, and so this may benefit them from not having to, take a distribution in a year that they're currently working, which would, exacerbate some of the tax issues that they may face.
And from my perspective, I just love that they finally got rid of that stupid half year.
Yeah.
I wish I could get back all the hours of my life that I spent explaining to various clients why it's 70 and a half. It's not 70 or 71. For whatever reason, people could just not wrap their head around that. And it caused so many issues with missing RMD distributions for the first time. If you miss your RMD distribution, what was it, a 50% penalty of the RMD that was supposed to come out?
Yeah, they take half what you were supposed to take.
That half-year issue caused so much confusion. You're dealing with seniors. They have a hard time understanding RMDs in the first place. You throw in that odd number in there and you say, hey, you don't need to take it now. You're going to have to take it once you get that half year. And it's also the year in which you turn 70 and a half. So it could push it back, an entire full year, which causes even more confusions on top of that. I just think moving it to a whole number really simplifies and eliminates a lot of that confusion.
Yep, and CFP exam questions.
Yes.
That's one of the busiest questions from retirement is now what age would they be and how do I do that?
Yeah, because it was nuanced, right? And so they wanted to make sure that people understood how to interpret those rules correctly. And one of the few good things that our Congress has done recently is eliminating that confusion.
Now, there still could be, in the old law, 70 and a half was the RMD age and 70 and a half was the maximum IRA contribution. There still could be some net tax benefit when we have deductible contributions happening beyond 72, even though they have to take an RMD. If you play with that math, you could see that the deduction could partially or fully wipe out taxes on that RMD. It depends on how big the IRA is.
Yeah, of course. Yep.
Yeah. But there again, virtually every financial planner works with folks on retirement. So this just touches everybody.
How big their qualified accounts are. Yeah.
So the next quality of life change, I think, is a huge quality of life change for a certain subset of individuals. And we're adding another exemption to the 10% early withdrawal penalty that a lot of people will get dinged at when they really need funds for a certain circumstance in their life. So previously, before the Secure Act, our allowed exemptions were for first-time home purchase and medical expenses over a certain amount of your AGI, which I think are the two biggest ones. Were there any other ones you guys can think of as far as exemptions from the early withdrawal penalty?
Education.
Oh, yes, that was what I was forgetting. Education as well for college.
Yep. So and then the fourth was kind of a catch-all, economic hardship. If you and your accountant could prove that there was an economic hardship, then you potentially weren't subject to that 10% early withdrawal penalty.
Yeah, my understanding was that was a very difficult thing to prove.
Yeah, it's enigmatic for sure, again, one of those things that puts you on a list for an extra set of eyeballs, which I don't think anyone wants to be on.
Right. And with the Secure Act, we are adding another exemption to that list. Now you can take penalty-free withdrawals for a birth or an adoption up to $5,000. So if you have a new kid, if you adopt a kid, you can now take up to $5,000 from your IRA. You're still going to have to pay the taxes on it because it's coming out of your traditional IRA, but you won't have to face that 10% early withdrawal penalty.
Yeah, I think that's a great addition.
Yeah, I mean, I don't think there's any debate with that one. I think it's just, giving people more flexibility with their IRAs, giving them more control over their money, and, not putting them in this feel bad situation of, oh, you just had this wonderful life event, we're going to tax you for it.
Yeah, we're going to penalize you for it. You mentioned something too about the medical expense. That went from 7.5 to 10, and I believe that the Secure Act dials that back to 7.5% again.
I would agree with that. Yep.
Oh, okay.
In terms of the 7.5% of AGI.
Correct. Yes.
Yeah. Yep. I agree with you.
Awesome. Anything else on that before we move on to the next point?
Nope.
Cool. So this one, I don't know about you guys, but this one I was actually really happy to see because this actually affects a lot of my friends. So living in Boston, Boston's a big college town, lots of research funded by colleges, R&D, scientists doing experiments, a big part of the Boston economy. And for a lot of my friends who work in these industries, the way they get paid is with fellowships and stipends. So they get these payments from the universities for conducting their research. Things considered, it's pretty much the same as getting a paycheck, but for the longest time, the big thing was it's not considered income for IRA contribution purposes. So all of my friends working in these education industries could not contribute to IRAs because it was not considered taxable income to allow them to make that IRA contribution. Mm-hmm. That's changed under the Secure Act.
Yeah, another welcome change, yeah.
That's correct. Yep. So the way that they word it is treats taxable higher education earnings as IRA eligible compensation. So that is a big deal, in academia.
And it's very interesting the way they worded that because they worded it in such a way as that it doesn't change the way that income is taxed in any other way. It's still going to be considered, and for all extents and purposes, how it was treated before. They're just saying, okay, now we're just going to allow IRAs to treat these as income. They're not overcomplicating these individuals' taxes in order to get them an IRA contribution. They're just, opening the door a little bit wider for them.
Yeah, that my son did several years, actually lived in Boston and did several years of postdoc work. And we were just talking about that when it had been nice to have that law then and make the contributions.
Funny how none of this is retroactive for at least a 3-year look-back period that you can do with a lot of other stuff. So
now the flip side of that is, unfortunately, so many of the students have large education loans. So the inclination to put $5,000 into the IRA will probably get trumped by this loan repayments. Right.
Well, actually, this also allows for there was a little tweak with that as well, if I'm not mistaken.
Yeah, I have that a little bit further down the list, but I think now's a good time. We'll jump to that point. And this one's kind of weird because it doesn't have anything to do with IRAs. This really felt like an add-on that they snuck in at the end of a bill that was snuck in at the end of an appropriations bill. Hiding it in a box in a box in a box. But so also a change, not to IRAs, but to 529s. So 529s can now be used to pay up to $10,000 of student loans.
Total, 10,000 total. Not, I don't think that's an annual thing. I think that's total.
Yes. Yep. Lifetime, 10,000 total of student loans or of a sibling's loans. The downside is if you do that, you cannot write off the interest on your taxes if you use a 529 to pay for these loans.
Sure. Yeah. I think this is really good. I just wish it was a larger number.
Right. Well, maybe it will be at some point in the future. Maybe they'll index it, but obviously student loans or the next or maybe not even the next, maybe the current issue that a lot of people are facing in terms of being able to save for retirement.
Yeah, for sure. And this I also put under the quality of life heading because I remember back in my day when I first started in the industry and working the help desk, which is basically just fielding angry phone calls from clients. A big complaint was these individuals had 529 set up. They took out loans anyways for whatever reason because they thought that's just what you do, and they were going to use their 529s to pay off their loans. And then lo and behold, they find out they can't actually do that. So it is nice that these 529s can be used now to make those loan payments.
Yeah, and the sibling thing in there is huge as well because you wouldn't have to change the beneficiary of the 529.
Right.
Yeah, it really is just kind of like I said, a quality of life change. Just makes things easier for everyone.
Yeah, and, also buried in that section, these expenses can be for registered apprenticeships as well as homeschooling.
Yeah.
Which could be interesting conversation with the child and the parent that, you must buy this Mac computer. Hey, I can use my 529 for it.
Right. Yeah. I think they also added expenses related, and forgive me if we've already mentioned this, I don't think we have, but expenses related to qualified apprenticeship programs are also considered qualified expenses for 529 plans.
So 529 is really starting to flex their muscle. They got some nice buffs in the Tax Cuts and Jobs Act. Now the Secure Act is giving them some more power.
I wish they'd do it the other way too, where they'd benefit a little bit, or make the IRAs and other qualified plans look more like the 529s, where you can stuff that 5 years worth up front. Because I think that would also go a long way to for people that have the ability to do it now that maybe didn't have the ability to do it then.
That would be great.
To allow the market to kind of cook on that money for an additional 5 years, as opposed to spreading out the contributions over a 5-year period.
My biggest holdout wish list for 529 plans is giving them some more investment flexibility. I think they're still a little too restrictive with, basically being mutual funds only of a certain company that, runs the plan. Up next for quality of life, we got 2 more here. This one's a smaller change, but might affect a fair bit of people, is the auto-enrollment cap for employer-sponsored plans. Auto-enrollment cap increased from 10% to 15% of compensation. Can either of you guys speak on that in a little bit more detail?
Yeah, I mean, this is interesting to me, and I just would love to know data and statistics on how many companies actually do this. The reason they do it is to get around some of the testing that has to be done, but you can opt out. So if they drop somebody in there automatically and it's 15% of their pay, does not the employee just turn around and opt out if they were not inclined to, initially? And I'm asking this more as a question than an actual experience.
Yeah, I mean, in my experience is that there's a lot of people that probably can contribute to a qualified plan that don't, just because of inertia. I haven't done it, and so if they make it an opt out versus an opt in, the thought would be that more people would actually save. Now, I think 15% is a pretty robust number. I mean, I'd be shocked if people contributing more than the match, let's say, outweighed the people who are contributing to the match or below. So 15% is, I think, a pretty aggressive opt-out. Even 10%, I think, was aggressive. But in general, I think it's good. It at least gets people started in their contributions.
Yeah, maybe the old "don't see it, don't miss it." It's
right. That's exactly right.
I live on what I take home.
Yep.
So.
Invest the money before you get it.
In previous jobs I've had that have had these, automatic contribution programs, it was gradual. So I think we when I was hired, the automatic contribution started at 5%, and every year I was there, it automatically ticked up 1%.
Yeah, that's right. Mm-hmm.
So after 5 years, you were contributing 10%. And the whole idea behind that is, like you said, Mike, you don't see it, you don't miss it. It's such a gradual change, and it should also more or less be taking place with wage increases that you get just from inflation increases to your pay.
That's a good point. Yeah.
That you wouldn't really notice the change in your quality of life, but you're increasing your retirement contributions over time.
And certainly when we talk to participants or eligible participants in a 401k plan, we'll say that there's a certain amount where, if you contribute, your take-home pay may actually go up, despite the fact that you're taking money out, because it reduces your taxable income. And so I think that education is a big piece of getting people to contribute to their. We all are very short-sighted. It's easier to kind of deal with things in the immediate term as opposed to worrying about the long term. Hence, why we have some of these issues and why these changes were taking place. But to Mike's point, if you can invest it before you can get your hands on it, you're much more apt to keep it invested.
Yeah, I do agree, though. I think 15% is probably a bit steep. Even if it was a gradual increase, also just if you're under this plan where it increases by 1% anyways, it's going to take you 10 years to get to that 15%.
Yeah.
Yeah. And again, they're just trying to get the numbers up in the plans and the contribution level up, because that affects then the highly compensated folks in the plan. So there's a lot in play.
So, Mike, there was a nice little quality of life change that you wanted to bring up, too.
Yeah, I think, tagging on to the auto-enroll piece, a good time to mention, I think, even something more beneficial, and that is plans can now include part-time employees in their, let's say, 401k or qualified plan in general. But 401k is where we'll really see this. Before it had to be full-time, and that meant 2,000 hours. Now, as little as 1,000 hours per year, or 500 hours in each of the last 3 years, they can be eligible to participate. And one of the cool things about this, if the election is made by the employer sponsor to go to 500 hours over in each of the last 3 years, the employer cannot consider those folks in the ADP testing, because that would be a real issue if you have part-time folks only working 500 hours a year and they come in at very low contribution levels. Then that's going to lower the ADP of that group and further restrict the highly compensated folks. But they can elect out of that and not count them in that math, which I think is pretty cool.
Right. And what's nice for the workers is that these companies now have to offer these workers the retirement plan if they're offering it to their full-time workers as well.
Good point. Yeah.
And that's really big for seasonal workers. I was seeing a lot of articles about this, that this is huge for people who are, work in agriculture, who work in tourism, work in these industries where they don't have full-time pay. They're not working year round just because of the seasonal nature, of the employment. Now they have the ability to open a retirement plan, whereas before they did not.
Sure.
Right?
Good point. Yeah.
That I put under regulations, but that is also a big quality of life change for a lot of individuals.
Yeah. Hopefully a lot more folks will be participating at some level.
Yes. And I think that's really the ultimate goal of the Secure Act, is to just get more people saving for retirement, make it easy for people so that they'll do it.
Yeah. I want to know the government wordsmith, though, that crafted the title of this.
Oh, yes. Yes. We probably should have read this at the beginning, but I do love the acronym that the Secure Act, setting every community up for retirement enhancement. Great name. All right, guys, that was fun talking about the quality of life changes that the Secure Act is going to have. Now let's really dig into the meat and potatoes of the regulations that are getting an overhaul. These aren't going to be seen as much from the individual client or employee, but it's definitely things that employers and especially financial advisors are going to have to keep in mind because it does affect the way we talk about these types of plans and how we run these types of plans. I think one of the big ones that this might get a little political here as far as, how this got added into this bill, but this one might be a bit more of the controversial side of the Secure Act is there's now employer liability protection for annuities inside of 401ks. So previously, 401ks, it was extremely difficult to have an annuity nested inside a 401k because of all the regulations and liabilities that came into effect, to the point that pretty much no 401k offered an annuity because it was just too much of a issue for the employer. They're trying to make that a little bit easier. What do you guys think?
I think it's the power of Life insurance industry lobby.
Yeah. This kind of amendment to the bill just reeks of lobbyists.
And it's interesting that in this environment where we've got regulation best interest coming in June, where we're increasing overall fiduciary exposure in the investment advice business in general. This specific area kind of reduces that fiduciary exposure, specifically inside of qualified plans. So it's kind of contra to the environment that we're moving to, is loosening up some of these exposures here.
Yeah, I mean, my biggest problem with it is 401ks are typically very restrictive with what you're allowed to invest in. It's usually your employer gives you a list of things to invest in and you get to choose from that list. So it's almost like an illusion of choice where, you're making your choice about, the S&P versus, a small cap fund, but you're still only choosing the funds that your employer allows you to choose from. And I just see the same thing happening with these annuities where, you want an annuity? Set it up through your 401k, but we're only going to let you choose annuities from, these companies that we have deals with.
Yeah, I feel for these employer sponsors and plan administrators. I mean, just because this gets so complex so quickly, and last person to probably is going to understand it is the participant.
Right. Well, that's true of most of it, right? But especially here when we're adding levels of complexity. Annuities are not easy to understand.
I mean, conceptually, I get it, and for some participants, it really might make sense to have income that they cannot outlive. It used to say you don't want to have too much life left at the end of your money. So this deals with that, but then how to pick and what the payout rates are actually going to be. What's actually going to be guaranteed. So anyway, I hope it goes well, but I'm fearful about that.
And it's also interesting that we moved away for so long from defined benefit scenarios, and now we're kind of putting a defined benefit inside of a defined contribution plan. And while it's technically not, in truly a defined benefit, it is, this guaranteed income. So it's going to be interesting to see where this falls out.
Yeah. Well, it made me think, Brendan. I'd be interested in your reflection on this, the longevity annuities, where you could take I forget how much it was, 100 and some thousand maybe, and put it into an annuity in the IRA, and that wouldn't count for RMD purposes. And did you see a lot of that action in your firm?
No.
Yeah.
Nope.
That's
almost none.
Yeah. So
a lot of that's driven by the advisor more so than the client. I mean, it's very rare where a client says, "Well, I was reading about this benefit," and calls and says, "I'd like to do this." Usually it's more of a push than a pull, and so we, I have not seen really any of those in my entire career.
That would have been what I expected to hear. So we'll see. You can make it sound really, really good with this piece, but I don't know. Stay tuned.
Yeah. What I feel personally, and anyone who asks, I'm still only would purchase an annuity from a fiduciary. Like, I don't ever see myself purchasing an annuity through my 401k. It just feels a little too shady to me. But I feel a lot of people who are probably the most vulnerable and the least financially educated are really going to be the ones who fall prey to this the most, especially for those, large companies where you have like your retirement planning day where, everyone gets to meet with the financial advisor who runs the 401k for the entire company. And you get to spend, 5-10 minutes with that financial advisor. And, if that financial advisor is motivated in a certain way, they could just be hawking annuities left and right in these people's 401k.
That's a great point. And I wonder, too, I haven't read any detail on this of will it only be fixed annuities, or will we see variable annuities in this offering? Will we see index annuities? And how do you sort all that out?
I think eventually you'll see all three. It'll be among your choices.
Yeah.
Yeah, I'm going to be really interested to see the conflict of interest documents that these plan sponsor advisors are going to have to put together. I'm going to be really interested to see how these annuity companies compensate these advisors who have, hundreds of people in these 401ks. Because that is a huge potential pool of customers for these annuity companies, and I'm sure they're going to do everything to get as many people signed up as possible.
Yeah, and this benefit is also portable, I believe. So the person that leaves is entitled to take it to the next place. So how's that happen administratively?
Right.
If it's not on the list,
Wow,
if they
yeah.
write a new one.
I didn't think about that. That is a nightmare.
Secure Act of 2021.
Yeah. We'll see. Stay tuned.
Absolutely.
We'll see what happens. All right. So up next on the list is, I think, probably the one item of the Secure Act that people are really upset about. The annuities, you got your pros and cons. You have supporters, mostly lobbyists, who are for the annuities. I don't know anyone who is that really for the this next change, which is eliminating stretch IRAs and replacing them with a 10-year rule.
The IRS was very much in favor of this one.
We found
Just, yeah.
They have
We
a
found
potent
the
lobby.
Yeah. Yes.
Yeah, I guess
Yeah.
the IRS lobby is pretty strong.
Yeah.
So first, let's kind of, under the old rules, can you guys explain what a stretch IRA was?
Sure, and simply it meant to stretch out, to spread out the payouts of IRAs over multiple generations. At death, RMDs must begin for the beneficiary, most beneficiaries, with a few exceptions, and then that beneficiary or that first beneficiary names another beneficiary, and so each one of them continues on with the RMDs over 2, 3, 4, 5 generations, and it was very popular.
Right, because it really felt like getting around the RMD requirements because because you stretch them out so long, the payments end up being very small over time.
And it was a very effective estate planning tool.
Yes, that's the big one. Get it out of the estate. It's in the IRA. You're still going to have to take RMDs, but it's going to be much less of a tax hit than the estate tax is going to be.
Yep.
And we ended up seeing, I guess this is why they started doing it. We're starting to reach the critical mass just because of the lifetime tables for RMDs that didn't always match up with people's actual lifetime expectancies, especially when people die on the younger side. I would see clients who were taking RMDs from a grandparent's account. Their grandparent died, left it to their parent. The parent started taking stretch RMDs. Then the parent dies, leaves it to the grandchild. Now the grandchild's taking RMDs for someone who's been, dead for 20 years.
There's a lot of financial planning that needs to be reviewed at this point. Now, there are some folks exempted from that list, including surviving spouses and minority children up to the age of majority, and then individuals within 10 years of age of the deceased IRA owner, as well as the chronically ill and disabled. So this is where the advisors really, really need to review the beneficiary designations. And are they in an exempted group? Are they no longer part of that group? Will they grow into that or out of that group? Just all kinds of moving pieces here to which this 10-year rule will apply.
Right.
Yeah, gonna be interesting. I think it's gonna be a really busy season for some estate planners. Anyone I would say with an inherited IRA is gonna have to consider this.
Yeah, and to Mike's point, it emphasizes the thoughtfulness that is required to be an effective financial planner, and making sure that the other experts, the accountants and the estate planning attorneys are also being thoughtful with their work so that the clients and their beneficiaries maximize the benefits that are available to them.
Yeah, this could also lead to some new business opportunities as well. A financial planner maybe hasn't worked with the client yet in the retirement area, or certainly maybe hasn't reviewed beneficiary designations, and this may open a door to do some additional work for the client. But, I think about the minor child, so they're exempted from this. but then they're no longer a minor and don't fit into the other categories, now we've got a problem, and that may be 5 years on the horizon for the client.
Right. And again, I think that's where, as with any new law, as things happen and it gets tested in courts, I think that you'll see common sense come into this and a little bit more clarity as to exactly how this stuff is going to work.
Yeah, and it's even worse for trusts.
Right.
See-through trusts that were set up as the IRA beneficiary, and we don't need to, that could be a whole episode in and of itself.
On its own, yeah,
but
for sure.
Just beware, if your client has a trust as a beneficiary of these qualified accounts, you really need to get to work on this. But we could also talk about, so what do we do about it? Is it time to revisit Roth conversions? We're at one of the lowest marginal tax rates that we've had in many, many years, and that might in the past the tax rates might have kept someone from converting. Maybe with this new rule, they might want to reconsider putting it all in Roth, because then the RMT will still apply at death, but it's going to be tax free. Yeah. Yeah.
For now, the Secure Act of 2025.
Yeah. Well, the other, and then we can move on, but, the RMD, it did away with the RMD. It's just, at the end of 10 years, this has all got to be out of there. And I believe with the trust, that would be the only option. 10-year, boom. And it's all taxable in 1 year. So from an IRS standpoint, probably looks like a lot of revenue being able to hit these things in one big lump sum.
Yeah. I didn't check the schedule. Is it 10% each year, or does it ramp up?
No, it doesn't. It just 10 years, it's got to be gone.
So I can skip RMD payments for 9 years, and in the 10th year I have to close the account? Is that an option?
That's
it all
exactly
has
right.
to be liquidated. Yep.
I feel that might almost be the safest way. I'm that's going to be a huge tax bill, but you could try and gamble on regulations changing in the next 10 years.
Good point.
Yeah, I mean, you can. There's a bit of gaming that can go in, right? Maybe you have worse income years than others, and that's an opportunity to get some of it out at potentially a lower tax bracket. But yeah, it's.
Yeah, maybe there'll be a new product, the options on this, whether it's going to change or not.
Yeah, definitely.
Options as in tradable options.
Man, I have so many questions about that. What happens if you do this, you don't take any distributions for 9 years, you die in the 9th year and leave it to someone else? Does the 10 years restart?
Yeah, that's a good, this may be something we want to research and reinsert or something. I kind of think it does restart.
But so I thought that was just going to be on growth, though. That's where I thought the original corpus would be needed to be removed. But again, that's so. When I was saying before that we need some challenges in court for this stuff to be more clear. These specific things are things that will be contested.
Yeah, because one of the potential strategies would be where initially just maybe an adult child was the beneficiary, and they were having the surviving spouse provided for in other ways. You reshuffle that deck and make the surviving spouse the beneficiary for it all, or let's say half of it. And so the spouse doesn't have required RMDs, but the child would start theirs right away. On the 10-year plan, that clock would start. But then when the other spouse dies and the child inherits that half, I think there might be a new clock on that half. But I'm not positive.
Yeah, I think you know what? You might be right about that.
What you're talking about with just the growth, that very well could be. But I'm thinking it does.
Yeah, and again, I there's just not enough. There's just not enough in any of the conference calls that I've been a part of to discuss these. I have not. It just hasn't come up.
Yeah, it's just really getting started. If you follow, I think you said you attended 3 of them on Friday alone.
Right.
Yeah, so we're going to start seeing a lot of this. It just kind of snuck up on everybody, being a end of the year thing.
Yeah, to be fair, the IRS is probably not entirely sure themselves. So it's
yeah, and it goes back to when DOL was coming in, the DOL rule was coming in. I sat in an audience listening to one of the lawyers who drew it up, and there was a lot of gray area. And she said it's going to take months and years for common sense to kind of fall into this, and that's never what you want to hear. hear when there's a huge change to the laws, and so, but it'll be the same with this. I mean, it's going to take some time to hear, what revenue rulings and court rulings, how it will shape things specifically to what you brought up, Jerry.
So up next, not as big of a change, but still interesting. And another bonus for small businesses like the mom and pops is multi-employer retirement plan 401ks are now allowed. So basically the idea is small business owners can join together and form pooled 401ks. From multiple companies to help share the cost of running a 401k.
Yeah, it'll be.
I just thought this was kind of interesting. I don't know how many people are going to take advantage of it. It's probably going to affect the other products that are specifically aimed towards small businesses. But I just find it interesting that now companies can kind of join together to share the costs of administration for these really expensive 401k plans.
That could be an area of qualified plan administration that emerges where because I look at this and I say, yeah, I like that idea, but who's going to facilitate it? How do you put the companies together? How do you initiate this? And maybe it is through groups and such, but I see it as a line of business for somebody.
Yeah, and they're most expensive at the beginning. The more assets that are in a plan, the cheaper they become. In terms of a percentage of assets and who wants to deal with them. And so I could see this being very popular with like trade groups and things like that. I think it's a great. This is a great addition. Yeah,
I think probably the main target of this is going to be like unions, trade association, like plumbers, carpenters. A lot of these are just like one-man operation. It's a guy in a truck, and he runs his own business, and now he has the opportunity to, have a 401k by kind of joining together with his plumber buddies or his, carpenter buddies.
For sure, yep.
So it gives some flexibility. What do you think this means for the, SEP, Simple, all the products that are, usually targeted toward these individuals?
The simplicity of those other things is awfully attractive. Easy to set up, easy to run your... Yeah. Now, another piece of this law change was in the past, a qualified plan would need to be adopted prior to the end of the year for which contributions were going to be made. The only plan that existed where it could be adopted and funded as late as the due date of the tax return, including extensions, was the SEP. Now you can do it with any plan.
Yeah, so I think if you're sole proprietor, so you still use that if you're kind of on your own, but as soon as you start having eligible employees, that those things kind of become less attractive.
Right. So we'll see. I mean, I'm hopeful this will lead to more people in plans.
Next change is kind of a small change, but I think it was, more protecting people from themselves. 401ks can no longer offer loans through credit cards, which I didn't even know existed, but now that
I've never known anybody that had that.
I've never seen it, but yeah, I mean, I tell people taking the loan out of the 401k is one step above burning the furniture, and so the fact that you can make it easy with a credit card is astonishing that was ever legal.
Yeah, like this is one of those rules that when it got put in place, I'm like, oh wow, I'm surprised that wasn't a rule already. I mean, they made it a rule because I guess it must have happened, but.
Yeah, somebody out there is saying, "Damn it!"
Yeah,
there goes the gig, right? But it's I've never ever seen it.
Yeah. They have to charge interest alone from a 401k. Yeah. I wonder if it was 20%.
Yeah.
And then you could consolidate them all into another card.
Well, if it's the standard credit cards,
I was shocked by that one.
Right.
So, well, that is a welcome change. I think we all wished it would have been not a rule that we had to make, but it happened somewhere. All right. So the final bullet point we have on this list is actually a big one. Another one of those just like random add-ons that did not seem related to the rest of the Secure Act as far as its focus on retirement plans. Kiddie tax going away. We just changed it. What's going on, guys?
Yeah, I was shocked by this one. And this one to me was like, oh, a major donor must have complained because they've got a bunch of kids subject to this tax. But I was talking to you guys over the last couple of weeks, like you did this change because it was tucked in a sentence that had to do with survivor benefits for the children of military. And then it goes on to say, and certain other incomed. And I didn't see where anybody was writing about this until now. And yet it's a big change with the kiddie tax. So anyway.
Yeah, so Tax Cuts and Jobs Act comes out, says we're no longer going to tax kids at their parents' marginal tax rates. Now we're going to tax kids at the trust and estate tax rates. We went through all this work, rewriting all the curriculum, learning the new rules. I did like it. It was once you knew it, once you understood it, it was easier to figure out. It was just kind of wrapping your head around the initial change. And now it's all for nothing. They're just going back to what it was, like less than a year. Did we even have a year?
No, probably just about a year. Yeah, probably just about a year, and
just in time for us to rewrite all the textbooks.
Yeah, right. Yeah,
my theory is this was actually a ploy by the textbook lobbyists so that they can print some new editions.
Very well could be true.
So it just went back to how it was before, right?
Yeah.
I mean, it's now at the parents' highest marginal rate.
Yeah, and I think it allows. I don't see it right now, but I remember seeing that it allows you to do it also for 2018 and 2019. So you could restate taxes under the new rules. I think going back 2 years.
Completely getting rid of it.
They completely...
Yeah, literally taking an eraser to it, like it never happened. If you don't want it to. I mean, if you want to, continue on with whatever you filed already, then so be it. But
Congress says, we're going to take a mulligan on this one.
So for the CFP, it seems like the March exam is going to be the only test ever to test on the kiddie tax rule, because
November did too.
Oh yeah, that's right, November did. So
yeah.
November and March is going to have the now old but was new kiddie tax rule, and now it's starting in most likely July. It's going to go back to the old way.
Right.
Yeah.
We'll see.
We'll hopefully we'll see some clarity on that pretty soon.
Right.
But
so that's all's well that ends well, I guess.
Yeah.
Right.
Awesome. Well, any other thoughts you guys wanted to close out with about the Secure Act?
Just read it. Get in there and read it.
Yeah, read it and pay attention, because I do think, as this was kind of tucked into the end of a bill, I think some alterations to this may be tucked into future bills, potentially even Reg BI when that gets completely signed in. There will be, I think, some nuanced changes to this as well. But in general, most of the stuff is good.
One thing I found very helpful, as you guys probably did as well, is there are a lot of articles out there now, but it's hit or miss of what all they're going to cover. I would read good articles on it, but also get a copy of the final bill so that you can go into that section and read exactly what was written to fill in some of the details or to learn about other things that maybe aren't covered in a particular author's article. But it's hard to distinguish sometimes. Is this the House version? Is this the Senate version? Is this the final? So try to find the final copy.
And if you are looking for a good summary, one of the best summaries that I found was actually put out by Congress. Congress.gov has a nice summary where they go paragraph by paragraph, and they basically write a one-sentence explanation of what the paragraph is for. So
okay,
if you don't have the patience to read through all the legalese of the actual bill, the Congress.gov article gives you a nice, non-biased explanation without, reading it through the lens of some writer for some company that has a particular agenda in mind.
Yeah, and if you, as you learn in your practice, to our listeners, more nuances and details with this, we'd love to be in communication with you. Give us a shout.
Yeah, if there's anything we missed, anything that's huge for you that we didn't think was that big of a deal, definitely let us know, because it's new. There's going to be a lot of changes with it. We don't really know how to interpret everything yet, so let us know what you care most about with this bill.
Absolutely.
Awesome. So with that, we're going to close it out. Thanks everyone for listening. You can check out all our older episodes at BIFBites.com. That's also where we have a bunch of other material to help you get ready for the CFP exam, and also just interesting stuff for the financial planners of the world. Thanks, Mike and Brendan. Thanks for joining us today.
Thank you, Jerry. Thanks, Brendan.
Yeah.
See you soon.
All right, guys. Thanks again, and Happy New Year to everybody.